In this video, I'm going to give you a 3-step method to use a 1-minute chart. First of all, make sure always that you make the chart never like this out. Always make the chart so small as possible that you understand step number 1, and that is that the market will always aim for bigger structure highs or bigger structure lows. So in this case, we have here a bigger structure low that you see here, and this is a bigger structure high. Just like from the bigger structure, you see it's an apex also here. So step number 2 is if you understand if the market wants to go down here or up there. And you might have catch yourself of searching references in the middle where the market is aiming at, and it also works. But the very big problem is that if you start to draw in very advanced these smaller structure lows, the problem is to underestimate where the market wants to go. If it wants to go here where my mouse is, or it wants to go there. And you don't have it that much when you more aim for a bigger structure low, such as here, or a bigger structure high up here. It doesn't matter from what time those highs or lows are. It's just that it's from the bigger structure. Step number 2, it comes with, does it make more sense for you if the market in this case made this move down? If the market made another move down, as you can see here, does it make sense here where my mouse is that the market reaches this low? Or does it make more sense for you that it reaches this high? And always keep in mind, there will be many days we are unaware and the market is also unaware where it wants to go. So our job as a trader is just to wait until we can see what makes sense, and then we do so. The orange background as you see here is the New York session time. It's from 9:30, it's from 10 a.m. until 4 p.m. in this case, setting here up the New York session time. And the thing is, with the New York session time, your advantage is that the market will aim for these reference in the session. Check this out. Here you have the biggest structure high, it's the highest point. That's why I make it always so small like that. And here you have the biggest structure low. And as you see here, it only was going to the biggest structure low. So once the market is down here, it's already too late. And before the market goes there, we want to see like, what is the movement the market does? This is step number 2. So what was the movement the market did downwards? You can see here the market goes down and then it has struggles here in a contraction phase. You can either measure it like that or measure it like this. If the market would do the same movement down, you see it would make sense more that the market goes down here. What are the retracements? I'm going to explain to you now what a retracement is. The market doesn't move straight down or up. The market always runs in retracements. A retracement is always that if the market goes in one direction, that it always comes back and then it goes down. A very good explanation as a beginner is just imagine the market wants to sell and go down, sell. Now people want to buy, because when they sell and they want to take their money, they need to buy to get out of their trading position. So for example, if we sell here and the market goes down and we buy here, then we made money, right? And the same also occurs to the masses of people. There are thousands of people trading every day. And you need to imagine a lot of people that were selling here were going out of their trading position here or even there, because here especially the market reached that destination, the goal. The goal was the biggest structure low in this case. And then people start to take their trading gains and then going out of their trading position. So for us, it's literally to trade before the traders are getting out of their trading position, what is very important. So in this case, we're going to measure the retracements while people have the retracement in the middle. The market is not just running one way in the middle and then down. It always goes down, people sold, and then people take their wins, like they need to buy. And then they're selling, and then they buy, and then again selling. It always goes on like that. So the market doesn't run in one direction, it rotates. And you want to measure what kind of retracement the market did. And what is very interesting, the same retracement from here to there occurs also from here to there, as you see here. From here to there, from here to there. This is not very accurate, as you see here. But starting up here, the market will start to make red candles. And keep in mind that this is something what is absolutely cool using price action, is that the red candle opens at the top and it closes at the bottom. And once the red candle closes, we want to have our entry after the red candle closes, and we have now something that is called the stop placement. The stop placement is that if I say, for example, I'm going to sell here where my mouse is, right exactly here, and that I have a stop placement that if the market goes above my mouse, that I'm going to buy. Because as I told you, if I sell, the market goes down, I need to buy to go out to make money. But if I sell and the market goes up, I'm losing money and I need to limit my losses, and then I need to buy. So in this case, stop placement should be very close, and then now it comes to the position size I'm entering should be so high that it's adjusted within $100. And what happens is that if we adjust here $100, we have $500 or even $800 down here. Check this out. Adjusting $100, and this is called the risk reward. And you can see here how we have here $580, 5.8 it says. What will be our profit, right? We maybe get here stopped out for the one or the other trader, sadly, but what we have, we need to re-enter the trade. It's called, we need to enter again and do the stop placement again up there to trade down here again. So the 3-step method says, step number 1, you identified now where the biggest structure highs or lows are. Step number 2 is you look forward. Does it make more sense that the market wants to reach the low or the high? Watch this video again, please. And then step number 3 is once you identify how big the retracement was in the past, and you can see the market does the same retracement here again, you take any small red candle to enter the trade with a tight stop placement. And please keep in mind, if you lose 5 times, please use a demo account and not real money account. If you lose 5 times $100 and you lose $500 in total, but you make 1 time, in this case it is $580, you make $880. But the interesting part is, check this out, the next structure, when you look more down here, maybe you have here also something more on the left side, whatever it is. In this case, you can see here the next red candle after touching the goal was going more down, and then the next candle was going more down. If you would exit here the trade, you would have here around $800. So it means we would have maybe lost $500 and made $300. Hope you can take something out of this. Wish you all love, good trades. JT out.